If you cut through the crap of QE and free money, what really matters on Wall Street is the profits real companies are making in the real world. You'd better sit down, this is not going to be pretty. According to John Authers in the Financial Times, a recent Thomson Reuters survey of American corporate earnings shows us that profits in the fourth quarter of 2015 were 3.5% lower than the same period the year before. Coming into 2016, the prediction for the first quarter was earnings would rise by 2.3%. The reality looks like being a further decline of 5.7%. When forecasts can be this wrong, it amazes me that analysts get paid to produce them in the first place. The global picture is no better. Societe General has looked at the companies that make up the MSCI World Index of developed markets and foresee a 12% drop in earnings across the board. This follows the greatest cut in consensus earnings figures since the height of the crash in 2009. Where do they get the data from that causes them to lower their expectations? From the companies themselves. They're clearly having their expectations managed downwards by companies eager to avoid a collapse in their QE-inflated share prices as economic reality starts to bite. The fall in profits reflects falling revenues. Turnover of leading European companies is expected to reduce by nearly 6% in 2016. While even American tech stocks saw a drop of over 4% in fourth quarter sales, including the Christmas period. And it's a trend that seems to be locked in for the foreseeable future. Citi is seeing earnings estimates at a 50-year low, while the market seemed to have priced in at least 4% earnings growth forever and a day. Even if you ignore the insane prices of stocks like Amazon, nicknamed the River of No Returns by hard-bitten brokers, there's a huge disconnect between priced-in expectations and reality. Dig a bit deeper and there is some serious earnings management going on. Companies are supposed to report their numbers under the generally accepted accounting principles or GAAP standards. These rules tend to reduce earnings because they take into account things like goodwill and amortization. So if we look at those same US companies using what are supposed to be the accepted international methods of stating earnings, we find they're almost 30% lower than the Thomson Reuters figures I just gave you. How can this happen? Well, companies are treating things like management bonuses and recruitment costs as one-off expenses rather than the regular cost of doing business. There's a technical term for this: lying. The more creative accountants also treat regulatory, legal and currency costs as irregular one-off items that should not be regarded as reducing a company's earnings. And you thought you just needed to study the annual report to see if a company was worth investing in? Even the GAAP earnings figures have been massaged by share buybacks, mergers and acquisitions using the almost free money available as a result of the continued stimulus policies of central banks like the Fed. So what does it all mean? It means shares are even more expensive than we thought, especially American shares. If you take the broker's view of the price-earnings ratio of the S&P 500, you get a figure of 17.5. In other words, it will take you just under 18 years to get your money back at current earnings levels. But if you take the much more accurate GAAP earnings, the price-earnings ratio shoots up to 21.5. That level's only been reached before when we're at or near the top of the market and getting ready for a correction. If you think you can get safe medium-term returns in the stock markets at these prices and these earnings levels, be very careful out there.